Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast. I'm also the founder and CEO at Family Office Association. To give a little bit of context to the discussions that I have, I help global families and their family offices solve problems, procure positive future outcomes, and prepare for intergenerational necessity. It's vital for families and their family offices to understand their vulnerabilities and become more resilient so they can mitigate risk and prevail in times of crisis. My experience with some of the wealthiest families in the world has allowed me to distill best practices for discovering purpose, refining vision, governance, structures, systems, processes, and culture that successful families and their safeguard family offices need in order to thrive. I help families create or reinvent their family office to be of institutional quality and highly adaptive. Today's discussion is how to access direct investing opportunities in the best startups. It features Ed Roman, who's managing director of Hack VC. To give a little bit of context to Ed, and I'm going to briefly read some of his bio, then I'm going to actually jump in and say, Ed, tell us a little bit about it because you have a great background. Ed is the managing director of Hack VC, a Silicon Valley venture capital firm. His mission is to democratize access to top Silicon Valley startups to investors. Ed has over a decade of venture capital experience and is a shareholder in several companies worth over $1 billion and 14 companies now worth over $100 million. Ed, welcome to the show. How are you?
I'm doing great, Angelo, and thanks for having me. It's a pleasure to meet everyone here today. And thanks everyone for joining.
Well, thank you. We're really excited to do the live Zoom today. And again, some of you may be watching or hearing this in other forms of distribution after the fact, whether YouTube or other platforms. I've heard about Ed for many years, and I had the fortunate opportunity literally about almost to the day a year ago to meet Ed on a beautiful day in LA when I hosted my Family Office Association LA. I think we actually bumped into each other on the outside terrace and caught up. And Ed is just such an active investor. So we're really excited to have him on. And Ed, if you don't mind, if you could talk about some of the startups, really even pre you becoming really a pure hardcore investor that you were running and highly active in. I think they're all intriguing companies.
Sure, happy to. So it's a pleasure to meet everybody, by the way, and thanks for your attendance today. So I've been CEO of 3 companies during my career. The first was the world's largest Java developer community called theserverside.com. And our mission was to get programmers around the world to learn about the craft of software development. And we sold that company for about $10 million to a publicly traded company back in the late 1990s. Second company was an exercise video game company. So we tried to help overweight gamers to lose weight playing video games. You might remember the Nintendo Wii system that came out about 5 years ago. So that system was basically a system that had a motion sensing controller where it would actually detect your emotions. So imagine, getting an upper body workout playing a video game where you could do punches and uppercuts and all that stuff, all to the beat of music. So we created these games, and it was a profitable business that spun out cash for several years. And then the last company I made was a marketplace for programmers to mentor each other on the web. So imagine Uber for programmers. Imagine you could click a button and another programmer comes to your rescue and saves you from your programming problem magically by looking at your code and helping you debug it. So we sold that company to Pluralsight, which is a publicly traded company. At the time they were private. They bought the company for about $50 million. I joined their board, and then we IPO'd the company for about $4.5 billion. And then I left Pluralsight to start this venture firm. So basically, my career has all been in entrepreneurship. I've been actually running these companies and learning a lot of lessons, making a lot of mistakes along the way. And after a while, it just became natural for me to give back and help other entrepreneurs to avoid some of the mistakes that I made when I was an entrepreneur. So I started to advise companies, started to angel invest. Then I started to help other family offices to find these deals. And then that led to me becoming a VC. So it was a very organic path.
Excellent. What a great background, and really gives you insight in terms of from entrepreneurship to successfully running companies to having exits. I mean, that's like the perfect profile you have of someone having access, connectivity, being an investor. And we're talking from a family perspective, which we'll get into, not just investing in a fund. And there's nothing wrong with that. That could be a great way to have diversity and to simplify your life, but to potentially be a direct investor. And I don't think access in some ways has ever been any easier in today's world with AngelList, with so many different platforms. I don't think it's a matter potentially of access. It's how do you source through that and make some strategic decisions, knowing, especially in earlier stage, that a lot of what you do, no matter how smart you think you are, and Ed, please jump in, if you're really early stage, a lot of what you do just is not going to work out. It's the law of numbers that even the best in the industry needs to make a lot of investments. So what we're going to jump around all over the place. Why don't we start in early stage investing, effectively seed investing? What are some of the advantages and disadvantages for a higher level family or a family office, besides the psychological impact of much of what you do will be money down the drain?
Sure, that's a great question. So I'm a fan of early stage, seed stage investing. I've done other stages too. The reason why I prefer the seed stage is that that's where you can earn the highest possible return. Now you have to have the right strategy to earn that return. So you can't just bet it all in one company at the seed stage. But just as a case study, if you were in Uber's very first round of funding, you would have earned a 3,100x return. You would have been able to turn $10,000 into $31 million. Now, realistically, most companies are not going to be like that. Most companies are going to fail. They're not going to be the next Uber. So you need diversification to overcome that. But through enough diversification and by making enough bets, you can actually hedge and you can transform the seed asset class into a better asset class, a less volatile, more predictable asset class that has the best returns. So that's kind of why we like the seed stage, is that it's just the earlier you go, the team that starts the company, generally speaking, those founders are going to stay with the company forever. And those are going to be the same people, whether you find them at the seed stage or the Series A stage or the Series B stage. And what we've noticed, and I don't know if you guys noticed this too, but what we've noticed is that the later stage deals are now quite overvalued. So, a typical multiple on revenue for a valuation for a company that's growing extremely fast on private markets could be as high as 100 times annual revenue. And we've had VCs mark up our deals at those ridiculous valuations because they were growing so fast. And so they're paying ahead in terms of valuation. So we don't think the late stage markets are very healthy right now. We think the public markets have been valued very richly recently post-COVID. And we think the private late stage markets have also been valued very high. And we think the bargains are basically only really available at the early stage now. So that's kind of where we focus.
Broadly speaking, I would agree. And that's one of the reasons why we're having you on, not because you agree, but because exactly what you just said. And I know it sounds simplistic, but again, I always don't know who's going to be hearing this or listening in. So let's take that little bit of a step back. When you're investing very, very early, you have potential. It's a long shot, but potential to get the kind of returns that you just said, like what, Jason Calacanis did in Uber, and he's been a frequent guest on the show, and others, to get that massive return for often relatively a more modest investment. Let's potentially say $25,000 to $100,000. But there comes a but, like anything in life. Again, what I said, earlier stage, even if you think you're pretty good at what you do, and so are some of the greatest earlier stage investors, a lot of it just isn't going to work out. So are you going to be comfortable making 10 investments at 50,000 where 8 may totally go to nothing, 1 may break even or make a little bit of money? Then you hope the 1 in 10, which is probably being a little optimistic, does really well. In reality, you really may need to make 100 of these bets to get that one that really, really takes off. But if you want more consistency in likely getting a positive return, you could invest later stage, but the valuation is going to mean that maybe you'll make 2, 3, or 4 times your money in a couple of years. And it's not the worst thing in the world, but you're never going to have that massive 100, 1,000, times X. It's just mathematically, it's impossible. How do you deal with investors to make sure they completely understand that trade-off?
Well, so we set those expectations with our LPs and our venture fund very early on. And if you're making a direct co-investment, if anyone in the audience here is thinking about investing in venture capital, we caution them to be very careful about evaluating their own deal flow, because the biggest mistake a family office can make is if they're not full-time as an investor, trusting entrepreneurs who randomly send them emails or introductions from not very sophisticated folks who are referring deals to them, you might be getting what's called adverse selection. Meaning you might be getting the leftover deals, the deals that the best VCs don't necessarily want for themselves because they're kind of cherry picking those deals and taking them for themselves. You know, a typical top tier venture firm might look at 3,000 to 4,000 deals a year, and they'll boil that down to maybe 6 investments that they'll make, which means they're throwing out thousands of deals a year that aren't meeting their profile. So this is the frustration that I had as a family office, because I have my own family office too, and I established it when I sold my first company 10 years ago, is that we basically realized that we were kind of getting some of these leftover deals. We actually lost money on some of our first investments because we just didn't know at the time that the best deals were being cherry picked by some of the more famous VCs. So what we're trying to do to address that, basically, and this is kind of an idea for some of the families out there, is first of all, if you go earlier stage, you're going in before some of these top tier VCs even know about the deal.
Yeah.
A lot of these top VCs have an ownership requirement. They want to own maybe 20% of the company, and they want to put millions of dollars to work. They don't want to put $100,000 to work or $500,000 to work because their funds have gotten so big and they've raised so much money. Some of these funds are billions of dollars in size. So imagine if you're trying to invest $1 billion, but you're doing it in 100K slices. You know, how many investments would it take for you to do, right? To actually fill out your entire fund. It just becomes unmanageable. Too many entrepreneurs to take care of, too many companies to watch. So a lot of them will just pass on these early deals, and they'll just wait for them to mature and get more valuable. And that's where the family office can really take advantage of things and get in at a low price. But then the question becomes, how do you know if it's a good deal? And how do you know you're not just suffering from adverse selection? So the strategy that we use, and this is an idea that some families might be able to learn from, is we actually form alliances with the top VCs. So I have a monthly phone call with Sequoia, with Bain Capital Ventures, with Lightspeed Venture Partners, with most of these top venture firms. And the whole purpose of those phone calls is for us to help each other to find great deals. So when we find a deal that we like, we don't just decide ourselves in our own due diligence that we like this deal. We actually send the deal to these other venture firms. We are literally giving away our best deals to other VCs. So that way they can become our partner on the deal and look at the deal with us and be a second set of eyes on due diligence and basically inform us about would they like to join us in this round, or would they like to stay close to it for the next round? Could they see themselves leading a Series A for this company? So we're trying to, so your point here, Angelo, is very well taken, right? Like, how many bets do you have to make? You're gonna have this huge loss ratio at the seed stage. Most companies will fail. Maybe you'll get lucky, you'll hit an Uber. We think a lot of that strategy can be improved. And the way you can improve it is by reducing the loss ratio, by only doing top tier deals, but doing them slightly earlier or alongside some other venture firms, basically. So we're basically trying to say, let's capture the top 10% or so of these startups. And then we're not going to capture all of them. We're going to miss a lot of these good startups too. We don't need to be perfect. As long as we're capturing a subset of them, right, we should have a pretty good return. So that's kind of our approach, is vetting and validating these deals through other venture firms.
That's an excellent approach. So in diving a little bit into that, the venture firms that you mentioned are the most iconic firms in the world. But exactly what you said, they're really not going to be involved in early stage. That's where it's a more inefficient market. We've had a couple of guests on that appear to be creating new mechanisms to invest in early stage, almost an index-like approach, which is intriguing. We'll see if that takes off. But I guess my question to you is, how would an ultra high net worth investor or family office narrow down the quality of their deal flow? And I would want you now, it could be Angelo. Well, I'm pretty connected and successful. They should get to know me. And we're going to get to that. But what are a variety of ways that they could enhance the quality of their deal flow to make better decisions?
So the biggest recommendation that I have in that regard is to form an alliance between yourself and one or more venture firms, because the venture firms are full-time evaluating these deals, and that's all they're doing all day. They have teams of people, associates and principals and partners, whose job it is to source, diligence, and then assist these companies after the investment is made.
Well, does that mean that I have to be an LP there?
Well, you don't necessarily have to be an LP. Like for example, the way that our venture fund works is that if someone joins our venture fund as an LP, we do give them preferential access to co-investing with us in these deals. But also we have a syndicate of family offices as well that we manage on AngelList. And we offer non-LPs those deals as well. So, there's a set of curators in the world. You're one of them, Angelo, and then there's a bunch of others like Jason Calcanis, and then folks on AngelList who are essentially providing a first pass filter on these deals, who are looking at them from a venture scale perspective, and who are kind of essentially assisting the family office with due diligence. And those referrals, I think, are something that family offices should be looking for. So as a case study, for example, when a family office is investing in a deal, you might want to look at, is there another venture firm in the round? It doesn't have to be a famous venture firm. It could be an earlier stage seed fund. It could be a fund like First Round Capital or Floodgate, or it could be a firm like any of the early stage, early pre-seed or seed funds. And the reason why that's valuable is that, let's say the company struggles. Let's say they take an extra quarter or two to hit their milestones. Well, you've got a deep-pocketed friend in the round with you that can bridge that company to their next round of financing. So the financing risk of these companies turns out to be one of the biggest risks. The number one reason why startups fail is they run out of money, right? Well,
it's true.
Having a deep-pocketed friend with you that's a real venture firm that can help bridge the company can be valuable in that regard.
If you don't mind, and if you don't want to mention the company name, that's fine, but maybe from afar. But if you want to mention it, it's okay too. So I connected with Ed a fair amount in the last month, and he shared a potential direct investment opportunity with me that was a very talented entrepreneur in Brazil that went through Y Combinator. And I'm going to assume that everyone on the call knows that Y Combinator is the most well-known incubator in the world, and they're based in Silicon Valley. That is not a stamp of approval that the company is going to be successful, but it's a good indicator. Ed, if you don't mind, so people could have a little bit of an understanding, could you walk through any of the mechanics on that specific company?
Sure. So this is like a good example of what we do at our venture firm. So, this is a company that we met about 6 months ago when I graduated from Y Combinator. We actually ended up passing on this company. We ended up passing because we were not sure how COVID-19 would impact the company in terms of their metrics. What this company is, they are a peer-to-peer marketplace for used cars. The company is called Carupi, C-A-R-U-P-I. And basically what they do is they assist you in the process of buying or selling a used car. So let's say you're a seller of a used car, and you don't want to go through the hassle of putting something on Craigslist, meeting a bunch of people to help sell the car. If you're female, you might have some safety issues, meeting strangers, right? When you're selling the car, you have to schedule that. Then you have to go through the diligence process. You have to handle payments, etc. So this company basically takes all that burden off of you, and they basically use gig workers to help you sell the car for you. So you don't need to actually meet up with any of the potential buyers. You don't need to risk yourself. You can still drive your car during the process. They'll just book appointments to take your car and drive it to the seller and meet, and then they take care of the payments as well. So the CEO of this company previously scaled a used car marketplace to 10 figures in revenue in South America. So he has a lot of experience in the space. So we met this company, 6 months ago. We liked them a lot. They were growing very quickly. We weren't sure how COVID would impact them. We thought, well, used cars, is that going to be an important area in the COVID world, right? Aren't people quarantined? Aren't people at home? Do they even want to buy a car? So we ended up passing. And then we tracked the company for 6 months. So for the next 6 months, we caught up with the CEO every month or so. He sent us updates. And it turns out that they're actually exploding on traction right now. They're growing 100% per month consistently for the last 6 months, even during the pandemic. So they're actually doing 9.3 million in annual revenue right now, which is phenomenal for a seed stage company. So now why did this happen? Why is this company growing so quickly? It's because it turns out that people are afraid to go on the bus or the train because of social distancing. You don't want to be around other people. You actually want to have your own vehicle. So that's actually causing an increase in used car sales. And this was uncovered when we performed due diligence by calling up a bunch of these used car dealerships. We called them up and asked them, how is your business doing in the pandemic? And their response is that they're having their best quarters ever, which really surprised us. So So this is a good example of like what a VC will do is they'll pass on a deal, they'll wait, let the business get de-risked a little bit more, and then at the right moment in time, they'll pounce and they'll invest. And then we offered this deal to our family offices as well for them to join in the round, basically. And we also helped find them a venture fund to co-invest with us, which is Streamlined Ventures. My friend Ulas Naik runs that fund. So this is just a great constellation of an investment. It's a company that's growing at a ridiculous rate, 100% per month. The benchmark for a good venture business, by the way, is 3x per year. That's the typical benchmark for the top tier startups that most of the top venture funds would love to meet. If you're going 3x a year, that's the bar. This company's growing 100% per month, which is way faster than 3x a year. So they're way above the bar there. It was very easy for us to find a co-investor, and we feel very lucky to be in that round. So that's a good example of like what the process is basically you meet a company, you track them over time, you help raise a round for them, you bring in quality co-investors, you give them a lot of runway, a lot of deep pockets around the table. And by doing enough bets like this, that's how you kind of can transform the asset class of venture capital into a more predictable asset class. And that's basically our mission.
No, that's excellent. And I think one or two of my live participants on the Zoom know, and Ed even knows a little bit of insight, that I'm extremely interested in earlier stage companies and understanding, of course, some tremendous risk with it. We're thinking of doing something special for my members of Family Office Association. I get not hundreds, probably thousands of opportunities every year, relatively given the relationships, including Ed and others that I have in the community, and more in Asia and around the world. Actually, COVID has made me way more global and connected than I've ever been before. We're thinking of a way that as a value-added member benefit, even possibly as soon as later this quarter this year, what we could do as an organization to provide even additional value-added opportunities. So simply stay tuned. I think we'll have some pretty big announcements on that in the coming, I don't know if I'd quite say days, but maybe, but for sure weeks. Ed, let me bring up to you what someone who, he said this tongue in cheek, but he meant it to kind of, Angelo, I went to Harvard. I was like near top of my class. I'm an earlier stage VC investor. And basically all the money that me and my parents spent on Harvard, here's basically what I learned about investing in entrepreneurs. A lot of them are not going to make it. When they start to show some metrics of success, you double down and give the winners more attention. And then he stops there and says, that's it. I need to invest in a good enough group of companies, understanding that much of them won't make it. Some of them, like the one you said, growing at 100% a month. Ooh, that's going to get my attention. They're going to get more help, possibly more money from me, because I see that they're the 5 or 10% that is going to climb to the next level. And he jokes, did I really need to go to Harvard for that? I probably could have learned that at a community college. And he's probably right.
Yeah, it's a good point. I mean, I will say this, that some of the best investors in the world have much more attractive loss ratios than that. So for example, a friend of mine was one of the managing directors at Bain Capital Ventures. He made 8 investments. Out of those 8 investments, only 2 of them actually one of the 8 actually failed. And that's because he missed something in the due diligence, in the legal due diligence for the company. The other 7 of them actually, were either return of capital or multiple on return on capital. But again, this guy's investing later stage. This guy's investing, Series A, Series B. They're not doing seed stage like you and I do. So at the seed stage, you are expecting higher loss ratios. And the way you mitigate that is through, like you said before, having a larger portfolio, but also, what if you just did better deals by making sure that you're seeing more deals, filtering more deals, and working with the top funds to essentially get the cream of the crop of those seed stage companies. And that's kind of what's interesting to me, is essentially taking the risk out of the asset class while preserving the upside and having reasonable loss ratio.
Because that guy sounds pretty amazing as a former Bain partner. What do you think was some of his, was it luck? Was it a very analytical, strategic mind? Was it simply he was getting great deals shown to him, which plays a little bit into luck in the decisions that he made?
Well, it's actually kind of funny because a lot of the investors that work at these top venture funds aren't necessarily that much better at picking startups than the rest of us, that are family office. right? The interesting thing that they have that we don't have is they have a brand. So if you're meeting with a Sequoia Capital or Lightspeed Venture Partners or an Index Ventures, and you're an entrepreneur and you're building the next Uber or the next Facebook, and you've got 10 term sheets from other venture firms, what you're thinking about is, does the brand of the venture firm matter? And the answer generally is yes, in that if they go with a famous venture firm, it makes their next round easier. It makes their Series A and their Series B go a lot more smoothly. It makes it easier for them to find customers, to find partners. So generally speaking, a family office, if you go head to head in a deal with one of those famous venture firms, you're probably going to lose that deal 9 times out of 10. So that's the adverse selection problem that family offices experience, unfortunately. And that's why we're big believers in the co-investment model of going alongside other venture firms, right? That way you're not competing with them, you're actually complementary to them. And that's kind of the strategy that we recommend.
Now, there's going to be some people, they didn't ask this question yet, but it's like, Angelo, if I'm investing mid to late stage and I'm looking at one of the top 10 or 15 companies, you mentioned some of them, Lightspeed, Sequoia, et cetera, some of them get just so overwhelmed. People keep on re-upping their investments. I just can't get in. So they have to either go through a fund of funds or find a lesser well-known quote unquote VC. And in true higher level, rounds, whatever B, C, and D, it does look like size and their brand name does seem to matter a little bit in terms of returns. The only way that they appear to have an edge is earlier stage.
That's right. You're exactly right about that. And most of these top venture funds are oversubscribed. Sequoia, Lightspeed, Bain, they've been oversubscribed for years. Even institutions can't get into those funds right now.
Right.
There's a long wait list. So family offices are kind of left in the cold there. And you're right, funds of funds can offer that level of access. But the problem with funds of funds is you now have to pay this extra layer of fees on top of the fees that these other venture firms already charge. So that makes it untenable for a lot of LPs, unfortunately. So, what we think is more interesting is, what if you were to invest earlier stage alongside some of these best funds, right? Or even before the best funds find out about the deals, right? At even lower valuations, more attractive than these top venture funds invest in, because their funds have gotten so large, they have to write bigger and bigger checks later and later stages, higher and higher multiples, right? So I generally agree, going earlier is better. Going, co-investing alongside top seed funds is a good strategy for a family office. And you just want to make sure that these startups that you're investing in are able to raise at their Series A's from good firms. And the way you de-risk that is to involve those Series A firms in the diligence process, which is what we do. And sometimes they'll even write a small check at the seed stage just because they want a toehold in the company. That way they can build a relationship with the CEO towards that financing round at the Series A, because they're worried they're going to lose the deal to another venture firm. So what if they exposed a small amount of capital at the seed stage, built that relationship, and they're in pole position now to lead that Series A? That behavior is becoming more and more common in Silicon Valley now. So generally speaking, the way that we think about this is, you got the universe of startups in the world. There's many thousands and thousands of companies raising right now. And your job as a venture investor at the early stage is, how do you curate? How do you distill all these thousands of companies down in just the few of them that you might want to invest in? And the way we recommend doing that is to rely on curators, smart people who you trust. These could be other venture firms like us, or it could be other family offices. It could be you, Angelo. It could be syndicate leads on AngelList. But the whole idea is that you're essentially spending years of your life essentially surrounding yourself and making it intentional to find people who are smarter than you are in different ways, who can help you curate these companies and help get you access to some of the best startups. And it's basically what we do for family offices who are in our venture fund.
We're going to come back and go a little micro and do some deep dives. Let's go a little bit more broader macro for a second and bring it into COVID-19, which is a different era. So your backyard, Silicon Valley, is the dominant number one in the community. It's been that way for a long time, but even here in the US, you have Boston, New York, LA, San Diego, Boulder, Austin, all well in making inroads. And globally, China, you could argue parts of Singapore, South Korea, certainly Israel. But the US is dominant there. Are they quite as dominant as they were 10 years ago? Probably not, mainly because China has made bigger inroads. Do you generally feel, and I know you're probably going to lean to be US centric, but for families that have the resources, have the money, and have the time, may they need to explore being more global. So we discussed offline, North America has a couple of 100 million consumers. Southeast Asia, just limiting it to Southeast Asia, has what, like 4 billion? The numbers would seem to dictate there's tremendous opportunities in Asia, yet many American non-institutional investors tend to be very, very careful, or maybe not know how they could get proper access and deal flow.
You're right, and this is a very good point that we're talking about here. So the irony is that a lot of US VCs are actually becoming more open to international investments now for a few reasons. One is because of COVID. So they're taking all their meetings on Zoom right now, which means if you're taking your meetings on Zoom, does it really matter how close the company is to you physically? And the other reason is that they can help the startup through their local resources. And that is something that you can't really replace. So, let's say you're a venture partner at a top tier fund and you spent your entire life in Palo Alto. Well, your whole network's in Palo Alto. So if you want to help someone hire a VP of sales or a chief marketing officer, your network is in Palo Alto. So how can you be useful to the startup if they're in a foreign country? So that's where a lot of VCs will struggle. So here's my advice for investing internationally. The first thing is, I do believe there's good international opportunities. If you look at, for example, who are the top VCs in terms of the Forbes Midas list and who's performed really well, it's actually Chinese investors who have done really well. They're at the top of the Forbes Midas list right now because of their performance. So there is a lot of good data that foreign countries are great places to invest, but there's a few caveats around that. The first caveat is that the publicly traded markets in foreign markets are not as healthy as US public markets. So for example, if you take a software as a service company and you IPO that company in the United States, the multiple on revenue for their valuation could be maybe like 10x their revenue, right? It could be a fraction of that multiple in a foreign market because their public markets are not as healthy as the US markets. So what does that mean? It means if we're investing at the seed stage or the Series A stage in a foreign market, we have to think about, okay, the valuation multiples are going to be lower when they IPO in that foreign market, which means we have to come in at an even lower valuation when we invest. So you basically have to be like hyper price sensitive. You cannot be investing in these foreign companies at US valuations. And that's what a lot of investors will fall into that trap of doing. So we recommend against that. The other thing to consider is that the follow-on financing risk is much greater for foreign investments. So let's say you're a family office and you don't have a lot of capital and you're putting in 25K, 50K into a company and you're the only investor in the round and there isn't a good venture firm with you. Well, that company could be in for a world of hurt because a lot of US VCs are biased against international investments for the reason we just talked about. Even though they probably shouldn't be, they still are, right? Which means it's practically much harder for that company to raise their next round, which means they're more susceptible to running out of money than US-based startups. So, again, joining with another venture firm in that round is a way to de-risk that.
And staying on the theme of COVID and other challenges, and I've heard Elon Musk say during the COVID era relative to California, where you are, going a little crazy about regulation, about taxes, about, for entrepreneurs, the cost of living and being in Palo Alto, was a reset, ironically, by COVID, which is changing the dynamic of commercial real estate, of residential, and then you have the fires, you have the tax issues. I mean, I could paint a little bit of a bleak and ugly picture relative to California. Is this making Silicon Valley realize that they may not be kings forever, and realizing that even if in the US that companies or great entrepreneurs could really come from anywhere?
No, you're right about that, Angelo. I mean, my general broad view of this is that, look, cities are not going anywhere, right? It's not like cities are going to disappear tomorrow, right? There still is going to be a role of cities in the world. It'll just be a more balanced kind of approach towards the world. So what a lot of entrepreneurs are realizing is that they don't have to pay San Francisco rent. They can live wherever they want to, live with their families. They can be out in nature in another part of the country. But more importantly, they can start to hire engineers anywhere in the world. And if you're building a technology company, that is your number one problem, because it turns out there's a shortage in America right now of 1 million software developers. And when a startup is raising their round of funding, if you're a really hot startup, you're building the next Uber, the next Facebook, you can get your money from anywhere, from any of the top VCs. What you really want is engineers, and that value add is really critical for you. So, and it's because the money is a commodity. What you need is help in terms of building that team out. And a lot of those engineers are international. Why? Because of US visa issues. You know, recently with Trump, he actually kind of put the kibosh on the H-1B visa a little bit. And it's harder for those engineers to get into the US now, which means that now having, you know, Slack and Zoom enabled companies, you can actually start to tap into that international talent. So as a case study from my last startup that I was CEO of, I had my entire dev team in Brazil. And this was not an outsourced agency. I did not use contractors. I had full-time employees in Brazil who spoke English perfectly and also spoke Portuguese. I do not speak Portuguese, by the way, but my co-founders did. And I was on Slack with these guys every day speaking in English, and they were in the same time zone roughly as me, because Brazil is only 4 hours time zone difference compared to Pacific time in California. And we just found that to be very attractive. We were able to get full stack engineers for $3,000 a month. You know, that's $36,000 a year. That's about 1/3 of what you'd pay in the US, and that's including all benefits. These engineers were never poached by other companies. No one ever tried to get them away from us. They were very loyal, and they were great. They were like phenomenal full stack engineers. So once we had that experience, we started to realize, wow, you know, other startups should do that too. So this is generally what we're recommending to startups these days, is to look international within a similar time zone. So in the US, that means Canada and South America. Those are your similar time zones for hiring engineers. And so it's been a big boon for startups. So you're right, you know, there are going to be international startups that are started all over the world. But we generally think that there is going to be a priority to go to market to US customers. So what I mean by that is, if your customer base is in the US, that's generally very attractive. Why? Because let's say you're a European company and you're going to market in Europe. Well, how many countries are there in Europe? And how many languages do they speak? And how many cultures do you have to understand? You have to build out a sales team for every one of those little countries. And every one of those little countries is a tiny market. Together, it might be a big market, but each country is a tiny market. So the nice thing about the United States as a market is that it's one unified body of folks who speak the same language, the same go-to-market, right? So a lot of these European startups will actually have a US go-to-market arm because they want to have an easier time with doing those sales. So again, like, it's a nuanced answer. Beware of valuations because of the multiples on public markets, and don't be the only investor in the round, because another venture firm, you know, may not be having the appetite to invest in that company, and then the company could round up money.
What have been some of the trends relative in the COVID era towards entrepreneurs doing some amazing things? Has it been software as a service, gaming? I'm assuming it's been something that's been very technically proficient and driven, but if you could tell me what you're seeing now after close to 7 months.
Sure. So we're generally investing in COVID tailwind companies. These are companies that are causing digital transformation, or they're positively impacted in some way by COVID. And we've been doing that since March, actually, since the pandemic started. We've been trying to be opportunistic about that because we think that in any crisis, there's always opportunity. You look at the 2008 to 2009 financial crisis, that's where you had great companies like Nutanix and PagerDuty and GitHub and Stripe all got created during that crisis. And they're all software companies. They're all IT companies. So we prefer IT software. And the reason why is because it's a software company. It's high margin. There's no cost of goods sold. There's nothing to manufacture. If there's something wrong with the software, you just change it in the cloud. You just fix a bug, push a new version of the software. You don't need to recall a bunch of physical products. You don't have returns, exchanges, all that stuff. It's a higher margin business. It's recurring revenue. So you subscribe to the software. In case your sales force decides we're not going to sell anything this year, you're probably still okay because all of your existing customers are hopefully resubscribing for the next year. So that's why IT software is generally a positive category. And it's backed up by public data as well. If you look at a couple of weeks ago, Snowflake had a huge IPO, one of the biggest IPOs of the year, right? IT software company, right? And that's what led the charge. And even back in 2017, before the pandemic, IT was the #1 asset class. It beat every other asset class. So IT and digital transformation is the asset class that interests us. And it's also the asset class that interests other VCs. And why is that important? It's because it's easier to manufacture the next round of funding when you have empathy for what other VCs are looking for. So even though it can be sexy to say, I'm contrarian, I'm different than all the other investors, I have my own opinions, there is something to be said about being in the category that other VCs like. That way they can essentially give you the next round of funding for your company. So that's generally what we're looking for, is these digital transformation COVID tailwind companies. And we've been kind of fortunate. We didn't expect this to happen, but March of 2020, the pandemic hit. We then hit the gas in terms of investing in these breakout COVID companies. And since we made those investments, we've actually had 6 up rounds occur since then. So meaning there's been another round of financing after we invested at a higher valuation from famous venture firms. Normally this doesn't happen because when startups raise, they raise maybe every couple years, right? But these companies, they're in this COVID tailwind category. So they're actually raising every few months. And that's kind of what we're looking for. That's the top 10% of startups where you can really start to earn your returns.
And when you say that during the COVID times that there has been some challenges for entrepreneurs and earlier stage startups, because the belief is when you get smart people, various different backgrounds and cultures willing to challenge assumptions together, there's a certain creative vibrancy that is harder for that young generation without the experiences to create if they need to be apart. What are you seeing as trends from companies that are kind of making it and those that are struggling more from that perspective?
I mean, culture is a very important aspect of a startup, right? Like the reason why people got together in a physical office before COVID was because of what I call the water cooler effect, right? You've got a team together and they're able to be hyper productive and have these hallway conversations that lead to exciting innovations that wouldn't happen if they were in a virtual world. And that's something that's very hard to replace with COVID. So what some teams are doing that we've actually invested in is they're actually living and working together. They're actually taking it to the next step, right? And they're saying, we're gonna create a kind of a safe haven of virus-free coworkers who actually live together. And I've actually lived in places like this by myself in the past. And what I've noticed is that you get incredible productivity gains if you live and work together in a co-working space, because you're basically just motivating each other to focus on your work. So the efficiency you get out of that is pretty astounding. Now, not all companies are going to be comfortable with that. A lot of founders, they don't want to combine their business and their personal lives and live with their coworkers, in which case they might have to resort to more virtual ways to collaborate. So, for example, we have an investment in a company called Loop Team. And Loop Team essentially enables the virtual office culture. So it allows you to have like virtual meeting rooms where you can actually like peek into someone's room and kind of join in a conference room like you would in the real world. And it's almost like taking Slack to the next level and layering on virtual conferencing on top of that. So we think techniques like that can be used to help assuage the issue. But I do expect that there's going to be a dip in productivity for some workers who are not able to self-motivate themselves. Because, as a founder myself, I've run 3 companies in my life, and all 3 of them have been virtual offices before the pandemic. So I learned a lot. I made a lot of mistakes about how to run a virtual office. And the biggest thing that I struggled with was, how do I cause my workers to feel included and to feel motivated? The hardest thing is, how do you trust your coworkers to actually get their jobs done? The only solution we've been able to hit on is what's called transparency. So we have systems of transparency where people, essentially when they create a work product, it's publicly reviewable by the rest of the company. And that puts social pressure on them to do their best work. And then you're not peeking in on other people and checking up on them, because everybody's work is transparent, so everyone trusts each other a lot more. So transparency essentially engenders trust. And that's the culture that we're essentially recommending to the startups that we invest in right now.
That's an interesting perspective. And Paul Graham has spoken and written about culture and the importance of that collaborative, that creative effect. So that's a great idea. That's a great suggestion right there relative to hold people accountable via transparency. I'm assuming, since you have experience having done this 3 times and you're seeing it now, being constantly on them 24/7, especially if they're not an owner, a quote unquote, a co-founder, that's probably overwhelming. In other words, there may be people that are amazing at what they do and what they output, And maybe they do it in 3 or 4 hours a day. If they're very transparent and they're amazing, do you really care? I would rather have them be great at 3 hours a day than be highly mediocre, but boy, I'm working 16 hours a day, right? I mean, I want them to be effective first.
Yeah, we don't care how many hours they work. What we care about is that the work product, the result of their work, is transparent. So a good example of this would be, I'm a programmer, right? If I'm writing code, I'm checking that code into GitHub, right? GitHub is where I store my code. And the other programmers on my team can see that code. So they can see what I'm working on. They can see what I've actually delivered as a result. The number of hours I'm working is not tracked on that system, right? What's tracked is the final work product. So another good example is I'm a salesperson, right? I've got a CRM system that tracks what leads I'm working on. How much revenue have I booked this quarter? That's a system of transparency. So what I'm suggesting is that for each department within a company, have an analogous system of transparency where the results of your work are available for anyone in the company to review. And the benefit of that is that no one ever has to check up on you. No one ever has to see, what are you working on it? Are you getting stuff done, right? Because it's all transparent and available, which means you feel more trusted because your colleagues essentially are never checking up on you, right? Because they can always just look at your result if they need to do that. So it empowers the culture to be much more positive.
No doubt about it. Do you think that pro rata rights are incredibly important? And maybe let's take a step back for those that don't know. What are pro rata rights and are they important?
So pro rata rights are it's the contractual right for you to maintain your ownership percentage in a company in the next round of financing. So for example, let's say you invest in a company at the seed stage at a $10 million valuation. Let's say you put 100K into the company at a 10 million post, right? You then own 1% of the company, right? Let's say some big Series A VC comes along and says, we love this company. We're gonna lead around into the company. We're gonna, essentially own 20% of the company, right? Well, that dilutes your position in the company by 20%. So your 1% turns into 0.8%. So you've just lost 0.2% of your position, right? Pro rata rights gives you the option to then buy up that last 0.2% to get you back to 1% at the terms of the new round. So you're investing at the higher valuation. And then after that, the pro rata rights go away. You do not continue to get pro rata rights for the next round of funding unless you renegotiate that in the new set of docs. And then you could get it in the next round too. Now, unfortunately, for a lot of family offices, especially for writing small checks, it's kind of challenging sometimes to get pro rata rights because for a lot of the best startups, they know that they have lots of VCs that want to invest in them and that everyone's fighting to get into this deal. And depending upon how hot the deal is, you might not be writing a big enough check to have negotiating leverage to cause yourself to have pro rata rights. Like if you're writing a 25K or 100K check, oftentimes the startup might say, well, we kind of want you in the round, but we kind of don't want to give up all these pro rata rights. So we're just going to pass on having you as an investor. And VCs and family offices hear that all the time if they're writing small checks. So to be realistic, you are not going to get pro rata rights in every one of your investments. Now, does that mean you should pass on the deal? My answer to that is no. I don't think you should pass. Because if you pass on all the deals that don't give you pro rata rights, you are causing adverse selection for yourself. You're basically causing the hottest startups to not want to work with you because you are only working with them if you get pro rata rights, and you're not writing a big enough check to command the pro rata rights. So in those situations, what do you do? So our recommendation is to do what's called essentially like handshake pro rata rights or good guy pro rata rights, or there's lots of words for this, but what basically the idea here is that you add value to the company, say by having a monthly meeting with the CEO and brainstorming on how you can add value. And if you do that enough times throughout the next round of funding, you have the moral high ground to demand pro rata rights in the next round, even though you don't actually have contractual pro rata rights. So that's kind of like the backup plan that we recommend if you can't get contractual pro rata. But if you write a big enough check, you can almost always get pro rata rights. So that's the tension generally, is it comes down to check size and how much leverage you have with the check size. So Angela, I don't know if your video cut off there for a second. Hopefully you can still hear me. I think let's just give Angelo a few minutes here. It looks like his video is a little bit choppy. And panelists, attendees, feel free to ask any questions while we wait for Angelo. You can just type out in the chat and we'll get to those afterwards. I noticed that Fred asked a question here. Please provide your definition of startups. Well, I use the word startups in a broad term just to mean kind of an early stage company that is kind of early in their progress level for the company. So that's kind of how I define startup. So looks like he dropped out. We're going to wait for him to come back here. But in the meantime, again, feel free to ask any more questions. And while we wait for him to come back, I'll go ahead and kind of address some of the questions that Angelo and I were going to discuss before he dropped out. Angelo, are you back now? Can you hear us okay?
I'm back, but I actually like that idea. So why don't I let you address some of the questions that are in the chat feature, then I'll ask my final question. We'll wrap up.
That sounds great. All right, so a couple questions here. So is venture capital competitive, and how do VCs typically work with each other? So that's a great question. So yes, venture capital is very competitive. It is less competitive at the early stage. The early stage valuations are more reasonable than the late stage valuations. And the way VCs work with each other is they generally are competing to lead the rounds into these companies. And most companies can only have one lead investor. At the best case scenario, you can maybe have two funds that co-invest together, but you're not going to have like three lead investors for a company. So venture capital is kind of like what I might call co-opetition. Like you're competing with each other, but you're also complementing each other because, generally speaking, you're not going to lead the same round as the next round. So let's say I invest in a company. I probably own enough of that company. I don't need to lead the next round. Another VC firm can go ahead and lead that next round. So I have to play nice and be friends with these VCs. That way they can lead the next round of the company. So it's both cooperation, but it's also competition. So the next question is, how is your fund doing in the post-COVID world? So our fund, again, we've been fortunate. We closed our second fund. We had a first close of our second fund in March of this year. And our first fund was good. We had a 28% net IRR with our first fund. So that's kind of like top decile performance. The second fund is too early to tell on performance right now. We have had 6 up rounds since March, so we've seen a lot of positive results. We'll do our final close of our venture fund probably early next year, and by then we should have a little bit more data in terms of returns. But we're cautiously optimistic because, in our opinion, a lot of these other venture funds have marked up our deals at higher prices, and that's a good indicator that the portfolio is doing pretty well. Last question here that we got is, how do you think COVID will impact things long term? So I'm generally a believer that we're not going to have a V-shaped recovery. It's going to be a longer term recovery. It's going to probably take a year or two for things to get back to normal. So in the short term, the impact is if you're not in a COVID favorable category, then you're going to have some challenges, essentially just keeping the lights on for the next year or two. And it's going to be tough for you to raise from VCs. If you're in that great breakout success category, you're probably okay. VCs are fighting to invest in you right now. The really interesting category is this middle ground. What about the people who are neither positively nor negatively impacted by COVID? And for those startups, you actually might have some challenges because it may be difficult to raise in the near future because there's going to be a lot of startups trying to raise, and a lot of them are going to struggle to raise because there's only so many venture capital dollars to go around. So generally, focusing on profitability, cutting burn, those are some of the things that we recommend. But we generally think about our investments over 5 or 10 years. So we think the COVID crisis will subside eventually. And even if you're in a negative category from COVID, you'll long-term probably be okay. The risk is the next round of funding. How do you keep the lights on before the recovery is complete? And that's where the challenges are. So Angelo, you had a question? Okay, looks like we lost Angelo for a little bit. So while we wait for Angelo to come back, I'll say one last thing to the audience, which is I prepared a PDF, which is essentially a set of best practices for investing in venture deals. And I created this PDF basically out of my own mistakes that I learned over the last 10 years. I've learned a lot from other investors and from my own successes and my failures. And if I could be helpful to you in terms of making sure that you're not making the same mistakes that I made when I was first investing, I'm happy to share this PDF guide with you. So I'm going to put my email address in the chat here. It's ed@hack-vc.com. I'm typing it in right now. If you want to email me at ed@hack-vc.com, I will send you this PDF guide on how to avoid some of the mistakes that family offices make when they invest in startups. So Angelo, are you back now?
Yes, Ed, could you hear me?
Yes.
Okay, good. And that was in case I wasn't able to come back. I didn't want you to leave, how people could learn more about you and reach out. So that's ed at hack-vc.com, correct?
That's correct.
Okay. And for those live participants, it's also in the chat feature, so you could see it there. I have a family that mentioned they're kind of effectively creating an internal VC and they want to invest in what they call a lot of companies. I'm like, okay, so very early stage, like $50,000 to $100,000 checks as if anyone does checks anymore, but you get the picture. I'm like, what do you mean? Like 20 companies, 50 or 100? And even if it's 100, that may only be $5 to $10 million. Again, I use the word loosely only, but it's $1 billion type family. And they're like, oh, no, we're talking about 500 to 1,000 companies. And I heard that. I almost fell off the floor. Really? I mean, isn't that going to make you more index-like? Where are you going to get access? How are you going to vet? And then I thought a little bit more about it, and I'm actually not so sure that it's not a crazy good idea. They believe that, whatever, what's the average? 1 out of 114 will be a unicorn. If you just do the math, depending on Prorata Rights and other opportunities, it may work out. I think it's a little overboard and too much, but what did you think of their crazy idea?
Well, the irony is that if you invest in a fund of funds, you're getting access to hundreds of companies, because a fund of funds might be investors in like 10 or 15 venture funds. And each venture fund might have 30 to 40 companies in it. So by definition, if you invest in a fund of funds, you're getting access to hundreds of startups. So is it a crazy idea? No, it's not a crazy idea, because that's what funds of funds do. The challenge is, how do you make sure that these are good companies? How do you make sure that you don't have a crazy loss ratio? It's very hard for an individual family to vet that many companies and to make sure that their top of funnel for deal flow is high quality enough. So the way that we de-risk that is we work with other venture funds that are curators for us, and we co-invest together in these rounds to access this top 10%. So I would recommend partnering with a strong venture fund to help you in that regard, if that is your strategy. It is achievable, but I would need to learn more to properly vet that idea.
Yeah, I mean, basically, it's a uber wealthy family kind of creating their own internal VC firm with potential interest depending on outside talent they bring in. Imagine if 15 years ago, Ed, you were approached by this kind of family that gave you some economic interest in the deals. You might have accepted that. So they have the resources to hire talented young outside people and maybe make it a commercial enterprise as it goes along. But yes, I'm learning more as it goes along as well. Any closing comments relative to earlier stage investing, relative to direct investing, to SPVs, to COVID, as we head to a close, Ed?
I would say, just in closing thoughts here, I started my family office a decade ago, and I made a lot of mistakes as a family office. And my mission is to help other families to avoid those mistakes that I made. So that's why I'm here today, is because it's very easy to lose a lot of money in venture capital if you're not careful about it. So that's kind of why I've been on this mission for the last 10 years or so. So if I can be helpful to anyone in this audience in terms of up-leveling the types of deals that you see, either through direct co-investments with us or by joining us in our venture fund, I'm happy to have that conversation with you. At the minimum, make sure that you email me for that PDF guide at ed@hack-vc.com, because that can save you just tons of money in terms of making mistakes that we made when we were first starting investing.
Great. And in my closing comments, this was quite a joy. I think Ed's doing some great work. He's always very thoughtful and insightful. And again, because we did discuss investing, you need to do your own diligence. Earlier stage investing, of course, by its very nature, is risky. In my opinion, you should be a family office level investor. Because again, the odds are most individual companies are not going to make it. So again, this is for educational, for entertainment purposes. Do your own diligence before investing, whether directly or through a fund. Everyone, I'm Angelo Robles. I'm the host of the Angelo Robles Podcast, and I'm founder and CEO at Family Office Association. a global membership organization dedicated to families of wealth and their family offices. We do a significant amount of original proprietary content. One of my members said you went from hosting 12 events a year or whatever, 10 or 12, to hosting 200, because near every day I do something for our members digitally on Zoom, and much deeper than often my physical event interviews were. So in many ways, things have never been more creative, more interactive, more global from my perspective. We're outputting a tremendous amount of original proprietary content, videos, masterclasses, and hopefully great near daily interviews. So it's a good time to be a member. Check out our website at familyofficeassociation.com. My email is angelo@familyofficeassociation.com. And I'm very active on social media. Our YouTube is simply Family Office, and you could find me on all the big platforms. My God, even in about a week or so, TikTok. I never would have thought I would say that, but hey, here we are. Ed, you've been a great guest. It's been great to have you on. And everyone, thank you so much for your time today. Thank you, Ed.
Thank you.